Welcome to the Salty Investors episode number 35. It is Friday, June 9th. Yeah, 2023. And how are you on this fine day, Tim?
Yeah, fairly good. Yourself?
Yeah, not bad. Beautiful day. Straight after this, I'm going for a walk just to clear the head because I've got to get all this crap out of my head that we're going to talk about.
Yep.
And so, why don't you lead us off, Tim? Lead us off with the salt for this week. What do you got?
It's a little bit old, but it's still ongoing. You see all these people who have got taken out loans, HEX loans, for the last 20 or 30 years. There's been no inflation. There's basically no interest on these loans, and all these people buy houses, cars, go on expensive holidays, pay the minimum on their HEX loans, and all of a sudden inflation pops up and they're inflation adjusted. And now they're complaining that they have to pay more, and it's all resetting at 7% inflation. Well, you had your chance. You could have paid it off early. You've used the service, pay it back. It seems like you're a little bit entitled here to a free education. You've got a great education. Pay back the government, you pricks. So I don't know why all these people feel like they're entitled and they don't have to pay for their education, and now it's coming home to roost.
Yep. Exactly. You know what? In 2001, when I quit my job and went overseas to work for a pittance, I still had HEX debt, and with the last remaining bit of money I had, I paid it down off. People told me, "Oh, you don't have to do that. Don't worry about it. It's not going to, And to this day, I think it's one of the best things I did. I never had to worry about it. It was peace of mind,
Yep.
Just paid it off. And I went overseas with very little money, but it was fine,
Yep. I did the same. The first half decent job I had wasn't earning great money, but pay off your debts.
Get that debt, get rid of that debt, clear that debt.
And all these people started to get tricky. I can invest in the market. I can put on my money into my house and all this sort of stuff, and. They still haven't paid off 20 years later. They're still holding on to the HEX deck. And they're going on these. Oh, I just can't believe it. But yeah. What are you salty about this week?
Well, no surprise. It's just the same as last week, really. I feel compelled to defend friend of the show, Phil Lowe, again, who made some common sense points after raising interest rates for the 12th time in 13 months. Good old Phil suggested that people may want to cut their expenses or try to pick up a few more hours of work to deal with the cost of living, including obviously higher mortgage payments, which naturally sent the Twitterati into a frenzy, people claiming, I already work 40 hours a week and so does my husband. Now, most Australians, of course, already know this, and they are making adjustments because they have to, and as we'll see later, that is showing up in the retail numbers. I mean, it is here; it has arrived, and but there is a contradiction here because the truth is, Phil would like to see the unemployment rate tick up, while suggesting people take on more hours. But that's just a reminder that there are no solutions here. There are only trade-offs. There are going to be winners and losers. Act accordingly.
Yep. Yeah. Well, the pause looks like it again, not looking good. The pause that Phil did, so I don't know.
I guess, let's just get straight into that, shall we? Because I did include some of Phil's comments from the statement, which, these statements are very boring. There we go. I mean, look, I still look at this chart and go, so, I mean, don't you look at this chart and go, yeah, look, we're back to where we were, just before, just after the financial crisis.
Yep.
4.1% is historically low. I'd like people to get this through their head, Like that woman the other week on Q&A. Oh, my friend's mortgage is 7%. 7%. Yeah. Anyway, but sorry. I didn't include that. I didn't include
Phil's comments.
Oh. Phil's comments.
No.
Whoa. Oh, yes, I did.
Oh, they're underneath.
What was I doing? They're down the bottom. Some further tightening of monetary policy may be required to ensure inflation returns to target in a reasonable time frame. So, more rate rises, not ruled out. Doesn't mean they will be, not ruled out. But that'll depend on, incoming data, blah, blah, blah. and they get the last sentence: the board remains resolute in its determination to return inflation to target and will do what's necessary. So they're not off the table. I mean, I did see some mob come out and say they think that they might get to 4.8%, but I mean, you and I, so we never, I don't think we ever said what the rate should be. We kept saying, look, inflation's 7, we've got to get up,
somewhere
inflation
near it.
Doesn't come down until the cash rate gets above inflation. Yep. We were nowhere near it. But I mean, I didn't think they'd go any higher than 3. I didn't think Phil had the balls, but he's proved me wrong.
Yeah, I thought between 2 and 3 would be the top limit of this, the ceiling. So,
yeah,
I just thought the economy couldn't handle it, but we're still chugging along pretty good for where we are. Like, we're on a 4 number now. So,
yep.
Yeah. And house prices still going up. So.
Yeah. Well, I mean, that's the sort of balancer here, which is you're injecting a record number of people into the country. They've got to live somewhere. They've got to have couches and TVs, and they're going to buy food. Woolies and Coles will be fine.
Yeah,
no problem. People can trade down, but they're going to put the volume through those places.
Mm-hmm.
But yeah, I threw this in as well because we had GDP out. Yep. GDP per capita in the quarter was down. So GDP is output. GDP per capita is per person, which is general. It's a broad measure for general standard of living.
Yeah,
it's gone backwards. Oh, what a surprise! If you inject loads of people into the country at the same time you're raising interest rates,
mm-hmm.
Living standards might go backwards. That's a good argument for why you should probably put a bit of a cap on immigration. Instead of just
at least temporary, until things improve. It's even the GDP number isn't too good.
No, it's year over year 2.3. That's anemic, really.
Yeah,
it's pretty anemic.
For some, we've still got iron ore, coal. We don't have to do anything. We just dig holes out of the ground and ship it overseas.
Well, imagine if we hadn't had that tailwind in the last 12 months.
Holy hell!
Yeah.
Yep.
Because which is strange because they're the only things that are working for us, and yet those are the same things that all the progressives want to tax the shit out of. So, because at the end of the day, they only ever have one solution: take money from those that have it and distribute it around. Don't grow the pie. Redistribute the pie.
Maybe they're thinking long term and they want to help Brazil out more than the Australians. If you up our taxes here, the Brazilian population would do a lot better.
I think you're giving them too much credit because that's sort of second order thinking. And
okay.
Yeah.
But they need it more than us, so sure, no, we'll leave it.
Yeah, no. Yeah, you're right. So this is from Deloitte. The retail recession has arrived, Tim. It has arrived. So retail turnover fell for the second quarter in a row. I mean, that doesn't happen very often. Retail sales overall, because obviously that includes food, not just discretionary retail. And if you've got a growing population, retail sales very rarely goes backwards. But as the bloke said, it's not a surprise. High inflation, rising interest rates, eroding purchasing power. So it's not unexpected, but I mean, we've been sort of, I felt like sort of maybe I was off in dreamland for the last 6 months or so.
Mm-hmm.
I thought, as we said before, I thought we were going to hear this sort of stuff late last year.
Yeah.
It's taken this long, but it's finally here. And just to, we talked about dusk 2 weeks ago. We talked about, did we talk about IDEXX last week? Maybe we didn't. Maybe we did. Maybe you and I talked about it offline. But so I included the dusk there. Their EBIT was cut from. Well, they didn't actually give you previous guidance. I don't think they had previous guidance. But anyway, EBIT was 26 mil last year. It's going to be 16 to 17. So, I mean, what's that? 35, 40% reduction in EBIT. IDEXX came out last week. You can see down there updated guidance for FY23. Sales were going to be 625 to 665. Now it's going to be below the bottom end of that range. EBIT's going to be cut from, say, 75 to about 63. So that's a good 20% knockdown. And they've reduced their capex slightly. And you'll see the same comments here. Impact of rising interest rates and higher cost of living has created more subdued trading environment. Since April, lower traffic observed both in stores and online. So online is not your savior.
Okay. How good are they at guidance? Like, are they pretty much on the money? Normally. Yeah, I know. Like,
Well, I think that guidance would be pretty. See the band there, like the group EBIT. It's pretty narrow, and that's because there's only 4 weeks left in the year. Because this went up to the end of May, basically, right? So there's only 4 weeks left in the end of the year, and in fact, these numbers aren't that important. It's what's the next year going to be like? Because if Phil keeps the pedal on the metal, and look, even if he goes on pause, if people are pulling back now with things on pause, things are probably going to get worse. So, I mean, it'll last year when I was saying, look out for the comments in the AGMs, it'll actually be this year that the AGMs will be really important, right? Because last year they were sort of saying, yeah, everything's fine. It's all clear. We've had a good,
good quarter. Good Christmas. Even Christmas was great. So,
yeah. And so I include a couple more. So top one is Best and Less. So they're forecasting NPAT of between 10 and 12 mil, and it was 18 to 20. So that's another 40% cut there, or more. And Baby Bunting was interesting because they have this promotional event in May, and they said the sales have been unprecedentedly low. I mean, it's a Mother's, because it's Baby Bunting baby stuff, so it's a Mother's Day promotion that they always have every year. Comparable store sales down around 20%, negative 20%, 21%. I mean, that's big. So they expect sales to be in the range 500 mil. Comparable store sales to be negative 4 to 5% for the year. But I mean, the important part is comparables are down 20% now. So that's, because that 4 to 5% for the year includes the first half, which was good, which was a good half. So, So again, when the results come out, all these guys are going to report in August. You're going to be reading the commentary there and look for guidance, see how many are actually going to give guidance, see how many are going to pull guidance, see how many. I mean, there's going to be dividend cuts everywhere here.
That scares Australians. Dividend cuts. Oh no, the world's coming down. I need money coming to my pocket every week, every month.
So as they said, as June delivers a larger proportion of the company's profit, continuation of the current trend will have a significant impact on the company's full year result. And look, they're forecasting NPAT of 13 to 15 mil, down from 21 to 24. That was their previous guidance. So look how quickly that comes down. That was their previous guidance, and that's been smashed down by 40% as well. So it doesn't take long.
No.
Well, too nasty.
Has taken long for people who've been waiting, yes, but
it's been taking long for us. We've been talking about it for 6 months or more. It's finally starting to bite, and so it goes back to Phil's comments. I mean, most people don't need to hear Phil Lowe say, "Cut your expenses." They are, because they're not idiots. They can see what's happening.
That's right.
I just pulled this one out. This is a sort of a recession watch.
Another
US
one.
Data. So ISM services plus. So this is basically new orders. The ISM is the Institute of Supply Management, and this is the services and manufacturing new orders together, plus the backlog minus the inventories. You see where the chart is there. The last. So you see the one in 2000 where it dipped below the red line. That was not a recession. Didn't get the recession until 2001. The recession was by American standards. Remember, we didn't have one, but that was the tech wreck aftermath, and it was pretty
isolated,
pretty mild. It only lasted about 6 months, and basically when 9/11 came along, it was pretty much over. Even though there was some panic after that, it was pretty much over. And that's because the tech wreck, to a large extent, was just an equity bubble. There wasn't a lot of debt involved, and it was pretty, most of the rest of the market was pretty well valued. It wasn't expensive. It was a real bubble. Obviously, the 2008, new orders fell off a cliff. We got that again in the pandemic, and now we're down into areas which, close to recessionary. And of course, the big problem here is, Tim, you've got 25 years of data and you've got 4 data points. And so you can't really draw any conclusions hard and fast. But I mean, just suffice to say that new orders being that low at least suggests a fair bit of weakness in the US economy. Because, you can now see in Australia things rolling over, I think, at least on the retail side. US has been more resilient, I think, than anyone thought, pretty much. It's starting to bite.
So they're not accounting for inventories, because I'm seeing a lot of, balance, and they got heaps of inventory, like because everyone in the pandemic, they stocked up and they put a lot more, holding a lot more stock, and so it's not really that. They're just rolling off those inventories. So this is minus the inventories. So it shouldn't be taken into account what they've got on their books. Theoretically.
Well, I think the measure is consistent over time, so it I still think it shows weakness, right?
Okay.
In as far as new orders are going. So I mean, it reflects a demand issue, right? Yeah. Moving on. Oh, that was me. That's me done. Oh, good. Now I have to shut up and stop talking. What do we got for us this week, Tim?
Yeah, well, I took the cat in for a freaking checkup at the vet, and like, every time I go into the vet, I check this company out. It's IDEXX Laboratories. So, as we know from Terry Smith, a dog or a cat now is like a full family member. So, they're expensive to look after. They need all the freaking blood checks and all that sort of stuff. And, see, they're all going well, because you can't let them pass anymore. They're a full family member.
Yeah.
So,
well, that's because, and that means that the pets are just living a lot longer on average, aren't they? Because we're treating them like your granddad or something.
Yeah. So our cat's 20 years old, to give you an example. So we have to go to the vet just for a checkup now, not like waiting for something to happen or whatever. Just check up. The old vet's doing all right. But so every time I go in there, I'm thinking, I'll have a quick look at the price of this and see how it's going, and have they switched out to something else? And you basically know that they can't switch out. They've been using this stuff for decades, this same this equipment. They make a packet on it because, they charge you $150 for a test, and it costs them, $20 or $30 out the back, and and so this company, supplies all the consumables that go with it. And you can just look at the numbers here, like they're buying back shares, and the things that scares you.
That return on invested capital.
It's out of this park, How do you get a 40s? Like, this is solid 40s, solid 40s return on invested. Like, this is like in the MasterCard, Visa type category of just printing money that no one, can sort of eat into their margins here, like 60%, you're even getting 30% operating margins. So, but you look at the price of it, and this is just insane. Like,
you're paying over 50 times. It's a problem. This eternal problem with quality stocks. What do you're never going to get the price you want.
Yeah, so, you told me last week, you should be holding your nose a little bit on some of these. You really love them. You really understand them. They're going to be here in 10 years. Like, I've been looking back 10 years, and they're still here, and they're going to be here in another 10 years. There's no way the vets are going to switch over to some other system. It has got a bit of debt. So if you flick over to the next slide, it's got no dividend. Interest coverage is 21. You can expect.
Yeah, well. Well, you don't want them to be paying dividends if they're getting 40% return on invested capital, do you?
Yeah, and comes to the debt question here as well. Your net debt is 1.3. your free cash flow is only, $500 million, but you're not paying any dividend. Like,
yeah.
so you could pay that off, quite easily, and but you'd want them.
So they did. Did
You
they
want to be
buy
taken on
something in
debt.
the last? Yeah. Did they buy something in 22? Because they added 400 million in debt. Did they?
Yeah. So you see from the at the top here, I think we've got you can sort of see from the cash flow. Oh no, I did the balance sheet. Oh no, yeah. So their working capital has changed. So I think inventories have gone up a whole heap. Oh no, inventories aren't too bad. Yeah, but something happened in there. I don't know what they purchased, but I think that was accounts payable or something like that didn't change. But yeah, I've forgotten now what was the change. But obviously they've taken on a fair bit of debt, jumped up a whole heap, but they can easily service that. There's no problem there. Yeah. But and I'll put another slide on. This is COFIN. So basically, it looks at over the past 10 years. You can do it for 20 years as well if you want. What's the PE? Right. Like, where does the PE currently? It's sitting at 45. So where does that fit in the history of it? It's about halfway. So it's not hugely expensive by historical standards, but like this is still, the price to free cash flow. It's in the upper quadrant there in the 84. So I don't know. I just hope, when do you get opportunity? Like, how do you buy this thing? How? When do you buy it? Like, how could you possibly buy this thing? Like,
well, that's the thing about last year. There wasn't really a panic, was there? Last year was just a slow grind down. And, what you really want to see is a panic where everything gets sold off because everyone's just shitting themselves. Get me out of equities. Everyone's trying to get out the door at the same time. We never really got that.
No. It happens like once a decade, but, like you sort of, but how
maybe
do you buy
COVID was it, because that was a panic where everything did sell off, wasn't it?
Yeah. So these things just seem impossible to buy, but you can see why they're so highly valued. And the question I keep asking myself, am I being too cheap? Should I buy some of this stuff? Obviously I don't, I'm not as sophisticated as Terry Smith or, Chris Holmes or something like that. But yeah, maybe I should be, thinking about these a little bit more. But, if something does crash, something seriously has gone wrong here. Like,
what did you say this? Where does this program come from? Because I think that's pretty useful to look at.
Yeah, it's a website called COFIN, and it's like there's percentage rank. I've always wanted this for years and years, and the Chinese have had it in all their stock analysis software. And it's just really handy to give you a quick, like if you still got a bit of a value mindset, what am I doing? Yeah.
So when it says price earnings, just take the top one. This 91 over here, does that mean it's in the top, like 90 richest valuations?
Yep.
Yeah.
In the whole of S&P 500, I think it is. So
and then so one back is the sector it's in, the United States healthcare sector, and it's in the top. It's still expensive relative to its peers, which you can understand to some extent, but this just creates the eternal dilemma of what do you pay for it, right?
Yeah. Yeah. So, this is top shelf stuff. Like, like you try and get something, not paying a dividend and getting return on invested capitals in the 40s. Like, that is insane. Like, and it's got a huge tailwind of animals, companion animals, people having less children. This isn't going to change. Even if we get a recession, people are going to still, spend money on their animals. It's going to probably get a hit here, but it's not going to be as bad as what you think.
What about aren't the environmentalists going to come through? Because they want to depopulate the earth. They want you to eat bugs instead of cows, so we can destroy all the livestock. At some point, they're going to have to want to start culling pets too, aren't they?
Yeah, well, I think that's maybe on the cards somewhere along the line, but a few people might fight against that a little bit when they don't have any children and all they got is pets. Like.
Yeah, well, People like their pets more than their children,
so
which is understandable.
Might turn a few people away from the environmental movement. You start saying stuff against pets. That's a pretty sacred cow nowadays. Like, you can't be going too far in that environmental direction. I think you'd be eating your base there a little bit. But yeah. So that's the question. I know what quality is, and this is it. Yeah. Like, this is in the MasterCard Visa category.
Yeah, you're right. I mean, it does feel like there's a strong tailwind with this stuff that people's caring about pets is not going to go away any time soon.
No.
It's just, if we do have a recession, some people might have to take the hard red pill and say, no, I can't afford $4,000 to fix the cat. I will put him down. You know, like before, remember when the vet used to just ring you up and go, oh, someone hit your dog and it's here at the vet now, and we want to know if you want to spend $500 to save his life. And you go, nah, just put him down. That was like, 30 years ago.
But it's not that long ago. Yeah. But that's changed totally now. So, yeah. But I think there will be a hiccup here, but it will be a hiccup enough to hit their earnings, because it's got to hit their earnings for at least 2 quarters before people go, oh, like, this isn't a great quality company, like, the earnings are going down, but this thing just keeps printing cash,
Yep.
So, yeah, that's the hard one. I'm just sick of going into the vet each freaking 6 to 12 months and seeing the price never changes,
Well, there is an alternative. There is an alternative, Tim.
What's that?
Well, make the hard choice. As Phil Lowe suggested, make the hard choice, mate.
Yeah. I'm trying to make that decision. It's just hard being a tight ass for your whole life and, paying up for something, that's all. So, yeah.
No. Well, there you have it again, folks. Tim's brought another one to the table. That's really high quality. And we will see you next week for another one.